Our next panel is all about blockchain, evolution from Financial Disruptor to Digital Cornerstone. We have Andrew Key, right? Yeah, we have Joey Krug and Sam Cassatt. I'm going to let you guys introduce yourselves during your talk, but please give them your attention. Let's get started. You all have microphones, yeah?
Yes.
Let's go.
Well, great job, Carla, Ricky, Happy. I think a key achievement here is you've gotten Dorado Beach residents to get out of their flip-flops and bathing suits and actually into work clothes. So congratulations there. So quick background, Andrew Keys. I was an operator and am now primarily an investor in this space. Helped build a company called Consensus, along with Sam, that created MetaMask and Fura, a lot of the early developer tools, helped bring Ethereum to market. Now run a fund named DARMA, Digital Asset Risk Management Advisors. Our goal is quantitative systematic alpha on Web3 protocols. So simply put, that means that we research protocols and take positions that are essentially 10 years long, not long, short periods of time, but 10-year theses, and then we try to generate alpha on them. So simply put, for example, with Ether, we stake it, and for every 100 Ether we have, by the end of the year, our goal is to have 108 Ether and 117 the following year, etc. We do that with the smart contract layer of the Web3 stack. We do that with the file storage layer of the Web3 stack. And lastly, I participate in a lot of investment DAOs, and we can kind of dig into what those are. But the idea is, rather than a GPLP structure where you have a few investment managers, you can have essentially the wisdom of a curated crowd where 100 people can make decisions together and come from various subject matter expertise. And my belief is that that kind of decentralized decision-making process can actually improve performance.
Thanks, Andrew. Hey, I'm Sam Cassatt. Been around this space a very long time. Since the very beginning of Bitcoin, really, I was into sort of the alternative currency community, computer scientist at the time, working on applied science research. I didn't really know what to do with Bitcoin. I thought it was cool and interesting, but I just sort of followed it. And then when this thing Ethereum got invented, I knew that would be something extremely important. It was change the face of the way that finance is conducted. And teamed up with Joe, Andrew, a few other people, and we started this, which basically funded the entire Ethereum ecosystem for the first couple of years. And as Andrew, several of the seminal platforms in the space. Fast forward a few years, I've also helped create a couple of DAOs, one of them being the Neptune DAO, which provides liquidity on chain. Also Startup Island DAO. I think my mic's cutting out a little bit. Island DAO that funds things actually in the local Puerto Rico ecosystem as well. I also founded a company called Aligned, which does high performance computing within the Web3 sphere. So also an investor in the space. Happy to be here and tell you all about the stories there.
Awesome. I'm Joey Krug. I co-founded two companies in the space. One that's a prediction market protocol called Augur. The other that's a fintech app called Eco, which is basically powered by crypto, but the users we target are people who don't really know too much about crypto. So kind of abstracting the benefits of crypto away for the end user. And then I'm one of the partners at Pantera Capital. We're a roughly $4.5 billion firm focused solely on investing in the cryptocurrency and blockchain space across early stage token and equity deals, as well as some liquid trading strategies as well.
So up until yesterday morning, I was going to kind of dig into kind of the state of the union between the protocol, middleware, application layer, and then kind of look into 1 year, 5 years, 10 years out. But anyone paying attention to this market over the last 48 hours deserves kind of an explanation, if you will, on kind of WTF happened to FTX. So yesterday, the second largest exchange allocated, or it was found out that they allocated a token that they created, FTT, the FTX token, to their sister organization, which was a proprietary trading firm, Alameda Research. And Alameda Research posted that asset, multi-billion dollars worth, I think $3-4 billion worth of this asset, and borrowed against it. So they posted that the FTX token as collateral, borrowed against it. And when that was found out on the balance sheet, basically a house of cards began to fall. Other counterparties that also had the FTX token as collateral began to sell it. And that created essentially a bank run. Anyone want to add?
Yeah. So precipitating that potentially was last week, a balance sheet was leaked of those organizations in CoinDesk, and that caused some astute observers to notice this exposure. CZ, who is the CEO of Binance, might have been one of those people, said he was dumping the token because of SBF. SBF is the CEO, came from Jane Street of Alameda, also started FTX. Said he was dumping it because he didn't like the regulatory position, but that sort of was the original domino. And then now there are multiple insolvent entities as a result.
So Binance, number one in terms of trading volume, is supposedly, potentially, maybe not acquiring FTX. First consideration. Second, FTX shareholders, I imagine, are drawn down to zero, unfortunately. So that was $32 billion worth of investment, or market cap investment, by some of the largest private equity institutions, sovereign wealth funds, Ontario Teachers Pension Plan, real adult risk managers deployed capital into this without, unfortunately, proofs of reserves. SBF's $16 billion net worth goes to under $1 billion. I don't think anyone really necessarily feels bad for him in that regard. And Alameda, the proprietary trading firm, gets drawn down from, I think, a $7-8 billion balance sheet to zero overnight. This kind of as well the 2008 feels. Any other knock-on that we should?
Well, there are a number of institutions that were exposed as counterparties, right? So every OTC desk that trades with each other often has cross exposure to each other. So there are rumors about Genesis, also one of the most upstanding organizations with exposure to this. So what's so impactful about this is that organization, and specifically SBF, are seen as upstanding citizens promoting the regulatory environment, the maturity of the regulatory environment. And so, the contagion of this is pretty intense for the industry.
I think the only thing I'd add is if you look at liquid tokens outside of FTT, which is sort of obvious, the other big knock-on effect here is Alameda and FTX combined held something on the order of $3 billion worth of Solana, most of which is locked up. And then you also have a huge percentage of the Solana supply, about $1 billion worth, which is supposed to be released in about 15, 16 hours. It got unstaked, over the last couple of days of events. And so, you're probably you've already seen a lot of huge impact to Solana's price, and, it's probably going to continue to be super volatile as a result of this stuff.
And multiple as well at FTX, Solana heavily. So
with all that said, and we can harken back to about 2-3 months ago when there was another large insolvency around Celsius, which was a centralized lending facility providing kind of yield. I do think we should bifurcate these types of institutions from kind of the world that is actually being built and the technology that's actually being built. And I think the simplest way to give that example is that these institutions, whether it was Alameda, FTX, Celsius, they went out to these decentralized capital markets and use decentralized protocols like Aave, like Compound, and there is a whole line of creditors, users of these products that FTX used, Celsius, and they're going to have to go through years of litigation, bankruptcy, processes, pay billions in legal fees, unfortunately. But in order for Alameda, in order for Celsius, and to a certain extent for FTX, to shore up some of their balance sheet, they have to pay back these smart contracts. So basically, to give an example, Celsius had $300 million worth of crypto assets that were sent into a smart contract called Compound. And in order for them to get that money back, they basically had to pay down their loan. And the only entity that was paid back in this Celsius example was a digital object on the Ethereum blockchain. Does that make sense to everybody? Yes, no, maybe? Or do you want to elaborate?
Just to expand on that, DeFi is still out there. Every single block executing its transactions, every protocol that was programmed correctly is still solvent and operating correctly, even though all these other house of cards have fallen. It's still out there processing transactions. And I would say, a friend of mine summarized it well. Like, if your solvency depends upon keeping your balance sheet or your business practices like secret, he's probably not very well run. So just a beautiful contrast between the promise of DeFi, one of the promises of the transparency of DeFi, versus the centralized entities that underneath have done things that maybe weren't the greatest sets of exposures.
So with that kind of macro backdrop of the current events over the last 48 hours kind of explained, I think it's important to kind of go from the bottom up in the tech stack on what we're seeing. Joey, do you want to take the merge?
Sure. I can give an overview of that. So if you look at the history of Ethereum, way back in 2014, 2015, there's always this plan to launch what was called proof of stake. And there's a couple big benefits of having a proof of stake system. One is that it allows you to get rid of mining, so it's much more energy efficient. It's also much more cost efficient to operate. And as a result of the cost efficiency gain, you don't have to inflate the supply of a network that has proof of stake as much as one that requires mining. So if you look at Ethereum and Bitcoin right now, Bitcoin actually has a higher inflation rate than ETH does. Actually, just yesterday, it looks like the current inflation rate of Ethereum is actually about 0%, which is really interesting. And that's possible because of proof of stake. So that's one interesting kind of dynamic that happened. And this launched in mid-September. So something that's been kind of people have been waiting for many, many years finally happened. It worked pretty smoothly without any issues. The second knock-on benefit that you get from having proof of stake is it opens up a lot more possibilities when it comes to scalability. There's certain things you can do in proof of stake systems that are really hard to do in proof of work ones. This functionality is not really turned on yet. There need to be what are called future hard forks, so basically future updates or upgrades to the Ethereum network in order to enable this. And those should launch at some point, some of them over the next year or two. And, what you end up basically with is a system that's quite robust, works pretty smoothly, and is much more scalable. And so if you look at the crypto space historically, the reason I think you have all these big companies like FTX or Binance or whatever that get a ton of usage is because they're centralized. They're able to be cheaper. And if you look in a world post scalability, we're already starting to see some of this. I think we'll talk about it later on the panel, some current scalability solutions that already exist. You're starting to see costs of using an actual blockchain go down. And if it takes, a fraction of a penny to do a transaction, people are going to use that versus today, I mean, prices on ETH have come down, so it's not as expensive, but still people don't like to pay $5, $10, $20 per transaction. And that's why these businesses like FTX and Binance have become so popular. But if you solve the scalability problem, I think naturally people will just use these DeFi systems because the big objection to it is cost. If you remove the cost problem, people will migrate over to it, in my view.
And not to mention that we go from an energy consumption to zero. Basically, the electricity consumption goes to zero. So in my simple algebra, you've got now a yield producing asset that's the most deflationary, that is also kind of ESG friendly. I think that kind of those three ingredients can speak to is looking for yield and kind of a yield starved environment up until relatively recent. When considering kind of the protocol landscape, I sometimes make an analogy to search. And when we think about search engines of, let's call it Web 2, 80% of search happens on Google, and 20%, and I think it's actually more than like 85, 90% of search happens on Google. And then the remainder, you have Ask Jeeves and Lycos and Bing and kind of 1,000 other search engines that are kind of fighting for that other 15%. Do we think that we are going to have that type of winner in a layer one landscape? So for like a global settlement layer, because right now it seems by many metrics, you can look at kind of GitHub repositories, little value locked, which are assets on the systems. Ethereum is somewhat running away and has kind of created escape velocity of the smart contract layer ones, or are there fit for purpose layer one that could potentially carve out a niche?
I have a couple things on that to say. So definitely Ethereum is like, second largest market cap by a lot. It has tremendous market penetration. But I think what's happened in the last, say, 6 months or so to a year is that different sort of architectures have been explored by a lot of very smart people, mostly enabled by Ethereum and all the smart researchers around the Ethereum ecosystem. There's something called eigenlayer, which recently has picked up traction, which is this idea that you can take staked ether. So what you've already done to produce the security guarantee for one network, like Ethereum, and then I can take that and I can expose that risk to another network, and that allows me to basically secure both networks at once with what they would say is like zero marginal cost of capital. Maybe that's debatable, but basically you can sort of lend your stake across multiple networks and expose risk, like slashing risk, which is what happens if you misbehave across those networks. And what that does is allows a proliferation of sort of new layer ones or different ways of thinking about the architecture to proliferate. Celestia is one of those. So Celestia and this sort of narrative has emerged that you could separate data availability, meaning sort of like the data storage, and then also the transaction layer, settlement layers, et cetera. And we think of Ethereum as sort of this monolith of all those things mixed together, sort of data, it's a transaction, security, et cetera. But what you can actually do is sort of unfold that, and you can take something, and I know I'm getting in the technical weeds here, but these rollups, which are ways to scale Ethereum. You could actually take that rollup, and instead of writing it to Ethereum, you could write it to a different data availability layer. So I think what's happening is this sort of like unpacking of the different components, the different architectural layers of the stack. And I think it's bringing a lot of innovation. And that's recently, even in the last few weeks, crossed over into the Cosmos ecosystem, which is fundamentally a proof of stake based ecosystem. But this same idea of eigenlayer of restaking has now emerged as this narrative of mesh security, meaning that every validator can validate every other chain within within the Cosmos ecosystem or ones that they choose to. And that also dramatically reduces the cost of security. The interesting thing about that and why you might want to do that is like, say you're a DeFi application and you're running on Ethereum. Every 12 seconds, you have a block, and say, there's some trader that's running a strategy on your application platform. And they're profiting in a certain way, but it's only because of some, logic in the way clearing works every 12 seconds. If you have control over the entire stack and you have control over a new layer one blockchain, I can actually build in the way that clearing works. I can guarantee that it happens in a certain time frame or not in a certain time frame, et cetera. And so I think as the field advances, you might want that level of control, or designers might want that level of control. So Ethereum, definitely the best, but I also think there are a lot of new ideas floating around that rely on these new architectural considerations.
I think to add on to what Sam said, I think today, given how the landscape looks today, you basically have like a question if you're building a project, right? It's like, which do you care about more? Do you care about more like the interoperability of being able to interact pretty seamlessly with other protocols? Or do you not care about that too much? And often it's actually like, there's often an actual answer. This isn't one of those things where it's like a philosophical debate and you could debate it for dozens of hours. For any given protocol, there's often an answer. You look at something like DYDX, which is a derivatives protocol. It's basically, synthetic derivatives. You can settle them in USDC or whatever. Interoperability isn't super important. And so you already see them, they were first on Starkware. Now they're building some stuff on Cosmos. It's just not important. It's not super important for them to interact with everything else. If you look at something like Uniswap, on the other hand, Uniswap is on the main Ethereum chain, has far more volume than Uniswap on, layer 2s on Ethereum or on, basically forks of Ethereum. And the reason for that is that it's much more seamless to interact with all these other protocols if you're on ETH itself. And so I think, like, at least for the next few years, the question that dominates is basically, do you care more about interoperability or application-specific things? Very long-term, over like 5 to 10 year horizon, you probably don't even have to make the trade-off. Like, technical solutions will come out where that's not really a question that you need to debate. You can get pretty close to like an actual answer there. But I think for the interim, that's kind of the question that it hinges upon. And for most people, I think it's Ethereum today.
So moving up from the protocol layer to layer 2, one of the crown jewels of Pantera's investment book is Arbitrum, which is the #1 used layer 2 in terms of volume. And I believe you drove that investment decision or were part of the team, and you should be commended because that's a great call. Can you dig into what Arbitrum is and kind of explain the dynamic, how layer 2s can optimize for speed and then kind of settle to the base layer?
Yeah, so Arbitrum's a really interesting project. It was founded by this Princeton professor of computer science, Ed Felton, super smart CS professor. He published a paper called Arbitrum, and it's basically this idea where essentially in a very high level fashion, what you do is you have this thing that's called a roll up, and what it does is it allows you to do transactions in a way that's pretty fast. It's a bit more central, or a lot more centralized, but as a fallback, if something goes wrong on Arbitrum, you can fall back to Ethereum, prove what went wrong, and essentially get your money back. And that's kind of like the design space there. The reason why we invested in them is we actually talked to everyone who was trying to build something like this, and we mostly asked them a bunch of questions about like what they thought about the user experience. And at the time, I had this pretty dogmatic thesis, which was that if you're a developer, I used to write software all the time, like you want to do the laziest thing. Like, what's the simplest thing I can do to make my thing work and fulfill my requirements? And so the lazy thing, if you're a developer, is you want to be able to take your Ethereum code, your Solidity code, and run it on whatever the faster layer 2 thing is while making almost no changes to it. If you tell me, well, you have to make all these changes, it's going to take you 1,000 hours of dev work, like, I'm just like, screw that, I don't want to do it. And so we talked to everyone trying to build this stuff, and Arbitrum was the only team, and like surprisingly, because they seemingly were very academic. In fact, they're both academic and extremely practical, and they were like, of course, why would we build it any other way? Of course, we're going to make it so you can just take your Solidity code and run it. They're actually the only team we talked to at the time. There's more competitors now, but at the time, that was the only team that had that answer. And so we were like, we should just back these people. They seem very practical. We led their seed round, and I think they're a really smart team, and yeah, huge fan of Arbitrum.
So continuing to go up the stack, or maybe this is kind of tangential, but we're in a world right now where every transaction on most blockchains are public. We can kind of see what's going on in the mempool. We can see what happens, and I believe the best analogy is we're kind of in a world where you have these permission blockchains that I would liken to intranets for kind of Web 2 legacy conversations. And in order for things like medical records or financial information of regulated institutions to go onto public blockchains, we have to have privacy. So you can have intranets move to internet. And I think the avant-garde technology around that is a field of called zero knowledge cryptography or zero knowledge proofs. Do we want to dig into kind of 101 zero knowledge proofs, and then we can maybe go into, rather than optimistic rollups, zero knowledge rollups and zero knowledge EVM?
Sure, I can take a pass at it. So zero knowledge proofs are something, it's very counterintuitive, but it's sort of this, like a lot of cryptography, it's sort of an accidental magical thing about mathematics that you can prove that something is true to another party without ever revealing sort of how you proved it, or not, without ever revealing the underlying data. So one example that's often used is sort of like, I can prove to you that I know where Waldo is in the Where's Waldo, by just taking a cutout of that and sort of overlaying it and showing that I found Waldo, but I didn't show you all the data that underlie that, how I sort of found it. That's one example of it. But what this enables is a couple of really notable things. I actually think it's much more expansive than this. Firstly, it enables these rollups. So a lot of people realize that what you can do is, instead of using the limited block space of Ethereum, for instance, to only fit, a certain number of transactions per second, you can instead, much like what Arbitrum did, you can use a different technique where you take a whole bunch of transactions, bundle them together, and you make this proof that says, these transactions were all executed correctly, and you write that proof to the blockchain, and that allows you to have a much higher amount of scalability. So there are a lot of people experimenting with that. There are also people experimenting with using the exact same technology for privacy. So, you could theoretically do it with something like medical records, although I think that's, potentially dangerous if cryptography gets broken in the future. But you can definitely use it for securing private transactions. In fact, there are already things live that use it, like Aztec, Mina, Zcash, to in an earlier form sort of uses it. So that's one extremely exciting direction. And sort of, when people talk about rollups, they usually will either categorize them as optimistic rollups or ZK rollups. Those are kind of the two techniques. I think Arbitrum would fall into the former. So a really exciting area of research. A lot of people, I think, are just sort of catching on to the idea that this could potentially be as significant of a technological development as blockchain itself, because now you have the ability to do what people call like secure multi-party computation, where say I'm SAP and I have a platform that a bunch of different logistics companies are connected to. So, I have Maersk shipping and I have a trucking company, et cetera. And they want to prove to each other that, the shipping is on time and there's this much, and that the temperature of the shipping container never reached this level, et cetera. They can all sort of prove to each other that their data is true and sort of what they're representing, without actually giving away their underlying business process data. So there's a protocol called Baseline Protocol that actually came out of Consensus, that's doing this work with like SAP, EY, Microsoft. EY, I know Paul Brody there is working on some ideas around this as well. So a lot of people that are deep computer scientists think, this is as important as blockchain technology. So I just want to make sure that bigger picture is there, but it's very exciting.
Anything to add? Nope. DK snarks are cool. Regulation. So regulation is not a monolith. Regulation happens across jurisdictions, across departments, and I think that, when we discuss regulation, it needs to be parsed accordingly. Does anyone want to give a first crack at what's gone on with Tornado Cash?
Yeah, I'm happy to take that. So if you look at Tornado Cash, quick one-liner on what Tornado Cash is, it's what's called a mixer. You basically put money in, a bunch of people put money in, then you withdraw money out, and you can basically sort of, anonymize to some extent the money that you put in. Like, you can't really trace it back to who put it in, because you withdraw it on the other side. Now, the problem with this is that you can use this for like pretty straightforward, like good things, which is just like making it so that someone can't track your transactions on chain. One use case for this might be like, basically you just want privacy on your financial transactions. Like, that's a fairly legitimate use case. A bad use case would be like you're, laundering money and trying to send it to ISIS or something like that. And so that's kind of the problem set. You look at the U.S. government, OFAC, the Office of Foreign Asset Control, basically sanctioned Tornado Cash. They sanctioned the smart contracts, and
bear with us, because that, I think, is important. This is the first time in the history of the world that a software object was sanctioned rather than a human being. And just like that example that the software object in the collateral case was the non-negotiable holder of the assets in the Celsius example, this is the first time that a software object, a robot, if you will, is sanctioned.
They have in the past sanctioned like addresses, because they said, well, this address is North Korean hackers. But yeah, to sanction a piece of software that is not connected to a particular human, pretty remarkable.
And this software, there's a prolific, the creator of Ethereum, Vitalik Buterin, who by all accounts is a pretty good guy, straight down the narrow. He used Tornado Cash as an example to donate money to the Ukraine for an orphanage. Literally sent $100,000, and because zero knowledge proofs are not built out yet, he didn't want the whole world to necessarily know that he made this donation, and he used Tornado Cash and basically sent $100,000 from his wallet to this mixer to a provable address that was a nonprofit, and he just didn't want the fame for doing it. And in essence, he basically went against OFAC sanctions.
And so basically what's kind of happened since then is this whole mess, which is a lot of addresses that basically have touched this Tornado Cash smart contract. People now view them as basically sanctioned addresses. And then there's a question of like, well, normally if someone interacts with a sanctioned entity, like, say Sam was like the head of ISIS and someone interacted with him, they're kind of like sanctioned by proxy, right? And so with blockchain-based systems, though, it's a much harder question, because like, what if I interact with Tornado Cash and then I send Andrew $100 from my address that's interacted with Tornado Cash? If you're now Coinbase and Andrew sends you money from that address, do you accept the deposit? Do you say it's sanctioned money? We're gonna, freeze it. What do you exactly do? And there are like some answers to this question, but it's also quite unclear. And companies and protocols across the space have taken wildly different approaches towards how to address this problem. And there's not like a huge amount of clarity surrounding it. You also have centralized companies that have taken pretty aggressive approaches. GitHub, for instance, I think pulled down the repository where the Tornado Cash code was stored. Forget if that got put back up or not. But and then the Treasury recently, yesterday, came out with some news basically clarifying that, if you're just like writing the software for this, they don't view you as sanctioned. But coincidentally, the person who wrote the software, I think, is based in the Netherlands or somewhere in Europe, and he actually got arrested, not because of U.S. reasons, because that jurisdiction thinks it should be illegal. And so it's really kind of complex interjurisdictional problem. And that's kind of like the summary of the current status quo there.
That sort of one hop away thing did happen. So people, interestingly, to test this, have done some, legally, philosophically interesting things. So people did send like, $100 or $1 or whatever to a bunch of celebrities from Tornado Cash to say, okay, are these people now sanctioned because they got $100? Like, interesting legal question. Intuitively doesn't make sense. I may or may not have a T-shirt that has the code of the sanctioned contract on it. Is that violating international sanctions? Wear a T-shirt. When I was 13, I had a similar shirt that had the RSA encryption algorithm on it, which was categorized as a munition and restricted from export from the United States at the time. So interesting legal questions. And I think, not to get too into the weeds, but now it's brought up a lot of questions in the underlying sort of like deep layers of the stack of the Ethereum protocol. So for instance, relayers of blocks, different relayers have different policies as to which blocks they'll include, right? If you're a miner or you're a validator in a proof of stake network, do you have a responsibility to not include those transactions that might touch OFAC listed addresses or smart contracts? People have different opinions about that. Depends where you are, and it depends on, what we think about the First Amendment. And so it's an incredibly philosophically interesting debate that's happening right now, and it's emerging in actual companies right now.
So with the remainder of the time, one question: where are we contrarians? Happy to start. I'm a Bitcoin minimalist, so that's my contrary to popular opinion piece. I think that Bitcoin kind of was the patriarch of this technology that said that the technology has moved on. I owned 0 Bitcoin. I think it served its purpose where it proved that Alice could send Bob value peer-to-peer trustlessly, but I think that it is essentially useless given the evolution of the technology. Most importantly, kind of the evolution of smart contract-based technologies. So now we can have, if Alice does X, then Bob sends payment, else failure. Kind of those if then else statements simplified are kind of smart contract code. And I think that is the connective tissue. Kind of the legal agreement is the connective tissue of this technology rather than the value or the money. And I think that's a core difference, because now we can tokenize all assets, whether it's an electron on a solar panel, an insurance contract, a stock bond derivative. That legal agreement is really the connective tissue rather than kind of a singular piece or monetary value, in this case, Bitcoin. Were you a contrarian?
You want to go first?
Sure. So I think I would say this is like a relatively incorrect time to say this, but I actually think the FTX stuff is very good for the long-term success of crypto in the overall industry. And I'll tell you why. So if you think about like what we're actually building here, it's building a more open, transparent, democratic, trust minimal financial system. And like the way to do that long-term is not to have like these centralized entities where you basically trust them with all your money. It's basically the legacy financial system, but it looks prettier and it's a bit faster. It's kind of like the same set of fintech companies you've had over the last 2 decades, which is they put lipstick on a pig, and the pig is the traditional financial system. And the only way to get away from that is for people to realize that these entities shouldn't really exist for a reason. And so if you look at kind of the early days of the internet, you had a lot of similar things happen. If you remember the early days of AOL basically had their own kind of like firewalled internet. There's also another internet company that everywhere you went in a hotel, they'd had this internet connected to the TV. I forget what it was called, but that was also like its own like firewalled kind of walled garden. And eventually people realized that the internet had to be this like open thing where it's like an open system where you can kind of interact with it and it's global. And, I would say in 2013, that happened when Mt. Gox blew up. And that's kind of like, I think, what sparked a lot of the early stuff behind like smart contracts and Ethereum and stuff like that. Since then, it's just been so long since we've had one of these big blowouts. People have forgotten like why we're doing this, why we're here. And I think this FTX thing is a huge reminder of like why it's actually really important to build decentralized systems. And I think it's something that's gonna set the industry back short term, but in the long term, like I'll tell you how we think about it at Pantera. We don't think of centralized entities and centralized exchanges as things that we inherently trust. We think of them as places to, if you have to, use them, then get your money out as soon as possible. And, we think about that being the case regardless of whether we're in like turmoil right now, or whether it's just a random Tuesday and nothing's going wrong. And I think this sort of event, like for people who came into the space more recently, maybe kind of forgotten about like what we're actually building. I think it's this pretty stark reminder. It's very unfortunate, of course. People are going to lose a lot of money here, and that's obviously very sad. But I think with the arc of history, 10-year plus horizon, I think this is actually going to be sort of a watershed, long-term positive moment for the space.
Makes sense. I agree with that. It's hard for me to answer this question because I'm just so steeped in all of these things, and I've argued with myself back and forth that I don't know what's contrarian. But I'll tell you some probably weird things that I think. Uh, but you know, to Joey's point that, putting lipstick on the pig, that's not sort of why I got into the space, right? Like we can take all the existing financial instruments, we can take the existing banking system, et cetera, and we can replicate it. We can, have the same rehab application of assets, the same general structure. And a lot of people, as they think about what this technology is like, yeah, it's fintech. It's making that faster and more efficient. When I originally got into this, and Ethereum was sort of described to me as a decentralized virtual machine, that meant taking, essentially BitTorrent and applying it not only to finance, but applying it to all logic, all business processes, and essentially being able to create a parallel and much faster evolving financial organism than we have today. Humans, we just naturally sort of gravitate, or, the entire history of the way that we've created corporations, governance, et cetera, it moves at the speed of pieces of paper, and it moves at the speed of court systems and boardrooms, et cetera. And when you take a whole bunch of kids that have no idea what that even is, they have no idea what, legal document even underlies a financial product, and you just give them some code and give them the ability to deploy it trustlessly and to the entire world at once, you just get this rapid type of innovation that we see in DeFi, where those primitives would never be possible as something that was written down in a piece of paper. It would never be possible if you had to have the existing regulators opine on it before it got launched, because the people who created it don't even know that that's what they're supposed to do. And that has created something that can move very quickly and create new primitives that we didn't have before, and is composable. It's sort of like, we use the word or the phrase money Legos often to think about, just like code can be plugged into each other, DeFi can be plugged into each other, and you don't even have to know the other party to do business with them. And so, I think that as the world evolves and as our views of sort of sovereignty, maybe thinking about Puerto Rico actually as a unique place within the global economy, there's an opportunity for the line to blur between what is code, what is like sort of First Amendment speech, and what is a blockchain and what is sovereignty. And I think in like a 50-year time horizon, I think that line is going to get blurred. And building parallel faster without necessarily trying to replicate the existing financial system is where a lot of the real innovation will happen. And people who are being born today are probably the ones who are really going to see that realized. But yeah, that's probably the weirdest thing I think.
Thank you.
Thank you.